although we certainly see some level of speculation in the market, and there's certainly some pockets of overexuberance, particularly in some of these Robinhood names, we don't think that this portends a systemic risk to the market overall. And in fact, at some level, we're very excited to see the increased participation by individuals in the stock market, something that we've been sorely missed for a number of years.
Is this the type of participation that you want? I mean, when I was growing up, I'm not that old, but I'm also not young either. I'm Gen X, and I was kind of raised to, hey, keep putting money in the 401k, look at index funds, get rich slowly. What does that say then about the new paradigm for investing or trading if this is the kind of thing that we can expect to see going forward?
Well, I would agree that it is very important for individuals as well as institutions to recognize that fundamentals matter, doing your homework matters. We believe that not paying too much for growth matters, and that getting rich carefully, as Jim Cramer would say, may be a more prudent long-term strategy than trying to get rich quick. Having said that, however, there's a lot of room in the market for a lot of different types of approaches, both on the individual and the institutional side. And if people have some money that they want to speculate with, to take a risk, particularly on stocks that maybe are very deep value stocks that are really out of favor, or on stocks that are very exciting, open-ended, brand new growth opportunities, that's okay as long as you don't risk more than you can afford to lose.
It sounds to me like you're talking about that acronym GARP, right? GARP, growth at a reasonable price. Those are the types of things that fund managers have talked to their clients about for years now. Is there still the ability at this market level, near record highs, at record highs right now for certain indices, to find growth in the market at a reasonable price?
There actually are tremendous opportunities to find what can be called growth at a reasonable price, what I actually like to call growth stocks masquerading as value or less well exploited stocks. Part of that is because when you look at the benchmarks, what we see is a great deal of concentration in some of the very narrow areas that have been the beneficiaries of the pandemic, or that have been very clear beneficiaries of some of the digital transformation, EVs, some of the most exciting parts in the market, but underrepresentation in areas like computer hardware, some of the consumer discretionary, in industrials, chemicals, and things like that. We think that if you look in these less well-exploited areas, and particularly if you look for companies that are benefiting from the big growth trends, so maybe a semiconductor company or a semiconductor equipment company like Ichor Holdings that will benefit from reshoring of manufacturing and the pervasive inclusion of semiconductors in all kinds of Internet of Things, Internet at Home, connected cars, car suppliers that can benefit from the move to EVs. Things like that can find places where there is growth that really is not yet fully reflected in the price of the stock.
If you look at the way things are setting up right now, Nancy, the way that we have kind of gotten to this stage has been through many different iterations of a kind of growth or value orientation. We've kind of gyrated between the two. Knowing what you know right now, if you take a look at that trade, is it the pandemic recovery trade that continues to play out? Are we looking at some of these cyclical type places in the marketplace, beaten down energy stocks, industrials, small cap type companies? Or are we just going to go back and say, hey, you know what? Big tech, mega cap technology has always worked. That's where I'm going to go towards now.
So we actually think it's going to be in the middle. The big cap technology companies have very good businesses. We do think that they are likely to underperform this year on a relative basis just because the expectations are very high. The growth rates were high last year. The comparisons are going to get more difficult. And we've certainly seen that with some of the reaction to some of the earnings. Although the earnings have been great and have been surprising, the stocks have not reacted as well. On the deep value side, it's very important to find companies where the business model is not challenged, where you're not seeing a secular decline. You know, the old story, you don't want to buy buggy whips after the car has been invented. You want to make sure you're not investing in those companies. Those companies in the middle, though, again, back to the growth at a reasonable price or undervalued growth stocks, is where we think that the market will shine this year. And in fact, if you look at what happened in January, particularly in the small cap space, what you saw was the factor that was the leading factor in that month were, in fact, those stocks in the middle that are good growth companies selling at reasonable valuations. We also think this year portends very well for small cap stocks. Now, we had a great small cap quarter in the fourth quarter, but one quarter does not make a cycle. We think we are potentially at the beginning of a multi-year cycle of small cap outperformance driven by valuation, driven by underexposure, particularly by institutions into the small cap stocks, and driven by an improvement, a steepening of the yield curve and the potential for a reflation trade.
Shepard Smith here. Thanks for watching CNBC on YouTube.